going to walk through some of this handout for you. So I'm going to get this to going on marketable securities and talk about them so you can maybe do better on your quiz that's coming up. So on your handout, I'm on the second page of your handout. We did this one in class. We talked about that. So this is short-term investments in marketable securities. Marketable securities, remember, are securities that have a market, so you can sell them. So they're usually the ones traded on the stock exchange. Right. The general rule for items are if every cost it takes to get the asset ready for its intended use is added to the cost of the asset. So if I purchase 4,000 shares of Coca-Cola Company on December 1st, and I paid $48.98, so 4,000 times $48.98 is down here, plus I paid a broker's commission of $80. I add that $80 to it because it was a cost to get the asset ready for its intended use. So notice that basically the cost of the security just went up. So 4,000 times $48.98 is plus the $80 is $196,000. So if I spread the additional $80 over all the shares, that's 4,000. So I have a $49 cost. So I put it into marketable securities. Probably a good idea to write 196,000 divided by 4,000 equals $49 each. Right after this, simply, or over here underneath this when you make your journal entry, simply because they are now worth $49. So if I sell one share for more than $49, I make a profit on it, but I need to know what it cost me at $49. Okay, the next slide, we hope to earn dividends on our shares, and in this case, they earn 30-cent share dividend. So 30 cents times 4,000 shares is the $1,200, so I have dividend revenue. So dividends are revenue, so it's simple as that. Okay, so here's where we sell them. So it is important to remember or have written down up here that we bought them for that $49 a share. So these were 4,000. Please write the journal entry. Don't just take the time to write it down. Don't just write what I'm writing down. So write down what is on this overhead over here, but I'm just going to put that over there. So we have 4,000 times $49 a share there. So on December 18th, they sell 500 shares of stock for $50.40. So remember, I bought them for $49. I'm selling them for $50 less a $20 broker commission. So actually, you can make this in two journal entries, but we got 500 shares times $50.40. So we got that amount, but they kept a $20 broker commission, so I got $25,000. So I'm going to debit cash for $25,000. The next thing, I have to remove my marketable securities for what I put them in there for. I put them in there for $49 a share. I have to take them out for $49 a share. So remember, assets go up with a debit. So my entry up here debited marketable securities for what I paid for them, $49 each. And now when I get rid of them, I credit marketable securities for what I paid for them. So 500 times 49 is 24,500. Notice I don't balance. I need a credit to balance. Whenever you have a credit to balance, you have a gain. Okay, so I made a little note up here that I sold 500, so now I have 3,500 left at $49 a share. So now on the 27th, I sell an additional 2,500 shares for $48.01. So I take my 2,500 times $48.01 less a $25 brokerage fee. So in other words, if I was going to, let's say, sell your car for, and you wanted to get $2,000 out of your car, I might charge you make it a $100 fee. So if you're selling your car for $2,500, but I'm going to keep a $100 fee, I collect the $2,500 from whoever buys it. I keep $100 and hand you $2,400. So that's the same thing that is going on here. Somebody sold it for us. So we had $2,500 at $48.01, but they kept $25 as a fee. So I got $120,000 cash. I get it out of marketable securities. I had 2,500 shares. They're in there for $49 each. So I get them out of there for what I would put them in there for. My debits don't equal my credits. I need a debit to balance, and a debit is a loss. So I have a loss on sale of investments, and I'll update this. Now I have 3,500 minus 2,500, so I have now 1,000 left. Okay, so now if you remember on our first day when we talked about cash is held at book value, marketable securities are kept at fair market value. So right now we have them on our books for $49 each. But in this one, on December 31st, which is the balance sheet date, whatever day you have your balance sheet on is the day you have to revalue them. So we have the remaining shares, so we have 1,000 left, have a current market value of $447,000. So we knew it was $49,000 because that's what we had them on our books for. So what I need to do is remember marketable securities is an asset. So I had put them in with a debit. So hopefully you've been writing these down. I put them in with a debit, take it out with a credit. So I have a debit balance left of $49,000. I need to get it down to $47,000. It could just have easily have gone up, in which case I would need to increase it to whatever it went up to. But to get it down, I credit it for $2,000, and I need a debit to balance, and that debit is a loss, and we call that an unrealized holding loss, because a realized loss would be these over here are gain when I actually did sell them. These are just a holding loss. So that's marketable securities. This is a little presentation, so notice that they tell you the current value is actually in the balance sheet, so we have them at market value, but we do disclose what they cost, and this is really, really important. Notice where the unrealized holding loss goes in. It doesn't go on the income statement for most securities. Some of them it does, but for most securities it goes in the stockholders' equity section, mainly because our wealth has increased, but we haven't got any income to spend off of it. So for instance, if you have owned Facebook stock in the last week or two, it has gone down. You don't necessarily have less cash unless you actually sell it.